Welcome to Wall Street Weekly.
Glad to be here.
So this week, the Dow Jones Industrial Average actually crossed the 50,000 milestone for the very first time in history.
Which is just incredible, right?
It is. I mean, billions of dollars in wealth were basically minted in a matter of days. But here's the crazy part. On that exact same afternoon, everyday consumer sentiment officially collapsed.
Oh, totally collapsed.
Right, to a level lower than the absolute darkest days of the 2022 inflation crisis. So today we are doing a deep dive into what is arguably the biggest, most glaring macroeconomic paradox of 2026.
Yeah, I mean, it really is the defining contradiction of our current era. We're analyzing the trading week of May 18th to May 22nd, 2026.
Right.
And honestly, the data just paints a picture of a system pulling in two completely opposite directions.
It really does.
You have these hyper-profitable enterprise corporations functioning as if we're in this, unprecedented golden age of productivity.
Yeah, making money hand over fist.
Exactly. And simultaneously, the everyday American household is signaling levels of financial distress that we historically associate with, well, deep structural recessions.
Which is wild. So if you are an investor looking at your portfolio right now, whether you're managing your own retail account or maybe you're strategizing for an institutional desk.
Or just looking at your 401k.
Yeah, exactly. Just trying to figure out why your 401k is behaving the way it is. This deep dive is absolutely for you. Our mission is to decode this fracture.
And we have a lot of data to get through.
We do. We've synthesized a mountain of market data from this volatile week. We're going to walk through daily index performances and the underlying sector rotations happening in the GICS sectors.
Right, the Global Industry Classification Standard sectors.
Yes, those. Plus, we're getting into the violent whiplash in the commodity markets from crude oil all the way to industrial metals.
And we absolutely have to unpack the fixed income market, too. I mean, the shifts in the yield curve this week, they essentially dictate the cost of capital for the entire global economy.
Which impacts everything.
Everything. Furthermore, we're pulling from vital macroeconomic reports released over the last few days by the UN, the IMF, and, of course, that bombshell consumer report from the University of Michigan.
Yeah, that report was a shocker because the surface-level numbers you see on the evening news, they're really masking a heavily turbulent, complex reality underneath.
Oh, 100%.
So let's start by laying out those surface-level numbers because, honestly, they are undeniably historic.
They really are.
The S&P 500 closed the week up nearly a full percent, hovering just below that 7,500 mark.
Which is huge.
It is. That represents an extraordinary 8th consecutive winning week for the S&P. That's its longest uninterrupted streak since late 2023.
Right. And when you look at 8 consecutive winning weeks, you are witnessing a remarkable display of market resilience.
Yeah, especially considering the headwinds.
Exactly. I mean, that upward momentum persisted despite severe restrictive headwinds early in the week stemming from the bond market. Institutional capital just continues to bid up equity valuations with this almost relentless optimism regarding corporate earnings.
And the Dow Jones, as I mentioned, was the clear outperformer. It surged 1.8% to close well above the psychological 50,000 barrier.
Historic territory.
Truly. And the tech-heavy Nasdaq composite, it gained about 1% as well. But then, Friday happened.
Friday was a wake-up call.
It was. The University of Michigan released its Consumer Sentiment Index for May 2026. And I was reading through this report, and it didn't just dip.
No, it fell off a cliff.
It plummeted to an all-time historical low of 44.8.
Just a staggering number.
I mean, for context, during the peak of the global pandemic lockdowns, or even during the worst months of 2022 and headline inflation was running over 9%, it never dropped this low.
Never.
So we have to ask, how are stocks hitting all-time highs while the actual humans participating in the economy are hitting all-time lows?
Well, the underlying driver of that 44.8 reading is this psychological phenomenon known as stagflationary anxiety.
Stagflationary anxiety. Let's unpack that.
Yeah, so if you look at the internal metrics of the survey, the collapse wasn't driven by job losses. People generally still have jobs.
Okay, so it's not unemployment panic.
Right. It was driven by a severe deterioration in household inflation expectations. The survey revealed that short-term consumer inflation expectations suddenly jumped to 4.8%.
Wow.
That means the average consumer firmly believes the cost of their daily life is going to accelerate violently over the next 12 months. And that's regardless of what the Federal Reserve does.
Yeah, I noticed in the data that the anxiety is highly localized around essential, non-discretionary spending.
Exactly. The things you have to buy.
Right. It isn't that people are worried about the price of a new television. They are expressing this visceral panic over the grocery store and the retail gas pump.
Because the global energy shocks we saw this week, which, we'll analyze in depth shortly, they're functioning as a highly regressive tax on the working and middle classes.
A regressive tax, meaning it hurts the lower earners way more.
Exactly. When retail gasoline prices skyrocket, it immediately drains discretionary liquidity from the household.
You literally just have less cash in your pocket.
Right. You are forced to spend a larger percentage of your take-home pay just to commute to your job.
Which creates what feels like a starkly two-tiered economy right now.
Oh, absolutely.
On one side, you have these massive, hyper-profitable mega-cap tech and software firms. They are successfully driving AI productivity gains. They've optimized their supply chains. And frankly, they are essentially immune to the cost of a gallon of milk.
They don't care about the price of milk.
Right. But on the other side, the everyday consumer is completely buckling under that heavy energy-driven inflation tax.
And that fundamentally reshapes how capital flows through the system. I mean, large-scale industrial and technological sectors, they're demonstrating real pricing power and margin resilience.
Meaning they can protect their profits.
Exactly. They can navigate wholesale inflation by just passing costs down the line or, optimizing their labor footprint.
But the end consumer can't do that.
No. The end consumer at the absolute bottom of that chain has nowhere to pass the cost. They simply have to absorb it.
Okay, well, let me challenge this narrative for a second then.
Go for it.
If the everyday consumer, the engine that traditionally drives, 70% of the U.S. GDP?
Roughly 70%.
Right. If they are tapped out and exhausted, how on earth did the broader market indices manage to rally so aggressively this week? I mean, why is Wall Street cheering if the foundation of the economy is allegedly cracking?
That is the big question, and the answer really lies in the mechanics of market breadth.
Market breadth, okay.
Yeah, this past week wasn't a rally led by a handful of massive tech monopolies carrying the entire weight of the indices.
Which is what we've seen for the past 2 years, basically.
Exactly. Instead, we witnessed a massive structural rotation of capital beneath the surface. Institutional money actively moved away from the market cap-weighted giants and aggressively hunted for domestic value.
Let's define that for the listener, because market cap weighting is crucial here. In indices like the S&P 500, massive companies like Apple or Microsoft make up a disproportionately huge percentage of the index's performance.
Because the index is weighted by their total market value.
Exactly. But this week, the capital flowed downward into the smaller tiers. So the absolute star of the week wasn't the Nasdaq. It was the Russell 2000 index, which tracks small-cap companies.
And the Russell 2000 logged an incredibly aggressive gain of nearly 3.4%.
That's a huge move for 1 week.
It really is. Similarly, the Russell Midcap Index had an exceptional week, gaining over 2.1%, while the large-cap Russell 1000 logged a steady but, much smaller gain of roughly 1%.
So the smaller the company, the better the performance this week.
Right, and this divergence is the defining characteristic of a broadening market.
But historically, smaller capitalization enterprises have been the absolute biggest victims of the Fed's higher-for-longer interest rate environment.
But they usually get crushed.
Right, because small caps are usually highly reliant on floating rate debt, meaning their loan payments go up immediately when the Fed raises rates.
Yes.
Mega caps, on the other hand, they locked in fixed 30-year debt at 2% back in 2021. So why did these highly vulnerable small-cap companies suddenly become the darling of Wall Street this week?
Well, the rotation was driven by a structural softening in long-term borrowing pressures late in the week.
Okay.
Combined with the fact that these small caps are heavily insulated from international chaos. You see, Russell 2000 companies are primarily levered to domestic economic activity.
They do business here at home.
Exactly. They operate within the borders of the United States. They don't have massive exposure to multinational currency fluctuations, the strength of the dollar, or, sprawling, vulnerable global supply chain networks.
Ah, I see. So as investors started getting nervous about the stretched valuations of those large-cap tech companies, they needed a place to park their capital.
Right. A place that still offered growth potential but had a lower entry price.
So they flooded into these high beta tiers, essentially stocks that are more volatile and reactive to the broader market.
Yep, and we saw sudden surges in regional industrial suppliers, specialized healthcare providers, and domestic data center power solution providers.
But the real sweet spot of this rotation, It seemed to be found in the Russell Midcap Index.
Oh, the mid-caps were the perfect Goldilocks trade this week.
Right. Mid-tier corporations perfectly captured the macroeconomic environment of this specific week.
They did, because they possess the stability of robust, seasoned balance sheets, unlike the highly speculative small caps.
But they're still agile enough to capture aggressive growth.
Exactly.
I was looking at the earnings scorecards in the mid-cap space this week, and they were just immaculate. You have companies like Ross Stores, the specialty off-price apparel giant.
The great indicator of the consumer trading down, by the way.
Yes, very true. And then Zoom Video Communications in the enterprise collaboration space, and Workday providing workflow software.
And what did they do?
They consistently cleared Wall Street consensus estimates. They proved that corporate capital expenditures, like the money businesses spend on upgrading their own systems, is still running incredibly hot.
And those earnings reports act as hard data validating the rotation. I mean, fund managers saw those clean scorecards and realized something important.
What's that?
They realized they didn't need to pay a massive premium to own mega-cap tech when mid-cap enterprise software is delivering double-digit revenue growth.
That makes a lot of sense. Now, this massive rotation of capital didn't just happen based on the size of the companies. It played out violently across the actual industries.
It was a very sector-specific week.
Yeah, we tracked this through the 11 GICS sectors, the Global Industry Classification Standard, grouping companies into categories like technology, healthcare, energy, and 8 of those 11 sectors posted positive weekly returns.
Which is strong. But the performance within those distinct sectors tells a very specific story about how institutional capital is trying to navigate the threat of sustained inflation and unpredictable interest rates.
Let's dive into the defensive and rate-sensitive complex, because this is where the market data gets genuinely weird.
Very weird.
If you look at your portfolio and notice that the utility sector, represented by the XLU, was up over 3.2%.
A massive move for utilities.
Right. And the real estate sector, the XLRE, was up 1.8%. You might be confused. I mean, utilities and real estate are usually slow, boring dividend plays.
Usually, yes.
But this week, they traded like highly volatile meme stocks.
Yeah.
What happened there?
Well, it is incredibly rare to see that level of aggressive price action in the utility sector. As you said, traditionally, utilities and real estate are considered defensive yield proxies.
People buy them for the dividend checks.
Right. Investors buy them because they pay out high, consistent dividends. However, because these sectors rely so heavily on taking out massive loans to fund multi-decade infrastructure projects or property development.
They carry a lot of debt.
Exactly. And because of that debt, their stock prices are hypersensitive to the 10-year Treasury yield.
The logic there is simple, right? If I can get a guaranteed, risk-free 5% return from a U.S. Treasury bond, why would I risk my money in a utility stock that only pays a 4% dividend?
You wouldn't.
So when bond yields go up, investors dump utility stocks, driving the price down.
And that underlying logic is exactly what set the trap.
The trap.
Yeah. Earlier in May, the bond market suffered a severe rout. Yields were spiking aggressively.
I remember that.
So anticipating that yields would continue to rise, massive institutional hedge funds heavily shorted the utilities and real estate sectors.
They bet against them.
Yes. They borrowed millions of shares and sold them, betting the price would collapse.
But the market loves to punish an overcrowded trade.
Oh, it always does.
Midweek, the 10-year Treasury yield unexpectedly pulled back from its spikes. It had been nearing 4.69%, but it suddenly retreated, settling near 4.56% by Friday.
And the moment that bond yield dropped, the fundamental thesis for all those short positions completely evaporated.
Wow.
The short sellers were suddenly caught off sides. To prevent catastrophic losses, they had to rapidly buy back the stock to cover their borrowed positions.
Which creates a short squeeze.
Exactly. When you have multiple hedge funds desperately trying to buy millions of utility shares at the exact same time, it sparks a massive, sudden surge in the stock price.
So if you are a retail investor wondering why your utility holdings had a banner week, it wasn't because of a sudden, deep love for the fundamentals of power generation.
No, not at all.
It was a mechanical, forced squeeze driven by the plumbing of the financial system.
Which happens more often than people realize.
Now, contrast that mechanical surge with what happened in consumer staples. The XLP sector, which tracks everyday necessities, fell almost 1.3%.
That's a significant drop for staples.
Why are staples bleeding while nearly everything else is rotating upward?
Well, the distribution of capital out of consumer staples is the direct corporate reflection of that devastating University of Michigan consumer sentiment crash we discussed earlier.
Ah, It ties back to the 44.8 sentiment number.
It absolutely does. The staples sector includes the massive manufacturers of food, beverages, and basic household products. These are the companies making your cereal, your toothpaste, and your laundry detergent.
And my read on the data is that these companies have finally hit the ceiling on their pricing power.
That's exactly it.
For the last 2 or 3 years, whenever the cost of raw wheat or cardboard packaging went up, these brands simply raised the price of the cereal box by 15%.
And the consumer grumbled, but they still bought it.
Right. But now, with sentiment at 44.8, the consumer is refusing to accept the price hike. They are trading down to generic store brands or just skipping the purchase entirely.
And that behavioral shift forces a brutal reckoning on the manufacturer's balance sheet.
Because their input costs are still high.
Exactly. Because they can no longer pass the escalating input costs onto the consumer, those companies have to eat the increased wholesale inflation themselves.
Wow.
Yeah, that immediately and severely crushes their profit margins. Portfolio managers reading the macroeconomic tea leaves saw this margin compression playing out in real time.
So they heavily rotated their capital out of the staples sector.
They got out while they could.
But here is the absolute wildest part of the sector divergence. While staples, the things you literally need to survive, were down, consumer discretionary, the XLY sector, which tracks things you buy for fun, surged nearly 2.5%.
It feels completely contradictory, doesn't it?
Totally.
How does that make sense?
It perfectly illustrates the two-tiered economy in action. The discretionary surge was heavily insulated by blowout earnings reports from luxury apparel components and premium off-price retail groups.
So rich people are still buying luxury items.
Exactly. It proved that the upper-income demographics, the households entirely insulated from the cost of gasoline, remain highly confident.
Their spending isn't impacted by a 50-cent jump at the pump. Right. Their discretionary spending patterns are completely intact. This provides massive revenue support for luxury brands, even while the lower and middle income brackets are tapped out in the grocery aisle.
It's a fascinating fracture in the consumer base.
Yeah.
But while the midcaps, the utilities, and the luxury brands had incredibly complex narratives this week,
Yeah.
the reality is that the fate of the entire global market still hung on one massive pivotal event on Wednesday evening.
Oh, the 800-pound gorilla.
Yes, the 800-pound gorilla of the global economy. The technology sector.
The technology sector, tracked by the XLK, finished as the top-performing sector of the entire week, up nearly 3.5%.
Which is massive.
But investors who only look at the Friday closing price will miss the extreme distress the sector experienced on Monday and Tuesday.
Let's walk through that early week panic. Because on Thursday, we got the S&P Flash Manufacturing, the Purchasing Managers Index, and it hit 55.3.
That's a massive 4-year high.
Yeah. And any PMI reading over 50 indicates that the manufacturing sector is actively expanding. When you combine booming factories with low weekly jobless claims, it sends short-term borrow costs spiking.
And that's dangerous for tech. The technology sector is fundamentally built on the premise of cheap, abundant capital.
Because they have to borrow so much.
Exactly. Tech companies borrow massive amounts of money today to fund research and development, banking on exponential growth in the future.
So how do rising rates mechanically hurt their stock price?
Well, in financial modeling, analysts use a discounted cash flow model. When Treasury yields spike, the discount rate applied to those future cash flows increases.
Which means future money is worth less today.
Exactly. It immediately lowers the present-day valuation of the stock.
So when the bond market started pricing in a higher-for-longer rate environment early in the week, these premium technology multiples collided violently with high capital costs.
And tech stocks were selling off heavily.
But then came the catalyst that effectively saved the entire market. NVIDIA's Wednesday earnings report.
Oh man, the scale of the NVIDIA earnings release is almost difficult to conceptualize.
It really is.
The company completely shattered Wall Street projections, delivering a record-breaking quarterly revenue of $81.6 billion.
$81.6 billion.
In one quarter.
Right. To put that in perspective, that represents an 85% year-over-year expansion for a company that was already one of the largest on Earth.
Let's really drill down into why this specific report was so critical for the broader economy. Because it wasn't just about NVIDIA selling a lot of microchips, was it?
No, it was about what those sales represent. The CEO, Jensen Huang, used the earnings call to provide highly aggressive forward guidance.
He painted a very bullish picture.
He confirmed that the capital expenditure pipeline for hyperscale data centers, the massive warehouse-sized facilities that power artificial intelligence and cloud computing, is still accelerating.
And this was the ultimate test of the earnings versus rates ultimatum.
Precisely. The market was legitimately terrified that sustained high interest rates would finally force massive corporations to cut back on their tech spending.
But NVIDIA's data proved the exact opposite. It did. The demand for artificial intelligence infrastructure is so overwhelming, so strategically vital to corporate survival, that companies are willing to pay the higher restrictive cost of capital just to build it.
So that single earnings report acted as a defibrillator for global tech momentum.
It brought it back to life.
It triggered massive multi-day rallies across peripheral sectors. I mean, if NVIDIA is selling that many chips, someone has to build the physical servers to hold them.
Right.
Someone has to write the enterprise data software to run on them, and someone has to provide the liquid cooling systems to keep the data centers from melting down.
It lifts the whole ecosystem. However, we have to address the fascinating and highly counterintuitive price action that immediately followed the release.
Oh, this was crazy.
Despite delivering a flawless historic earnings beat, we witnessed a classic sell the news reaction on Thursday morning.
Yeah, NVIDIA stock actually dropped roughly 1.6% in early trading, dipping down to $219 before eventually stabilizing.
Which confuses a lot of people.
I always find this mechanic fascinating. How does a company report $81.6 billion in revenue, beat every single metric, raise forward guidance, and the stock price actually goes down the next morning?
It is a function of market expectations and liquidity. You see, institutional investors had already priced absolute perfection into the stock in the weeks leading up to the report.
So there was no room for upside surprise.
Exactly. Every ounce of good news was already baked into the valuation. When the official news was finally released, it acted as a massive liquidity event.
Meaning a lot of shares were changing hands.
Right. Algorithmic funds and large trading desks utilize that heavy retail buying volume to quietly pocket their profits. They aggressively took chips off the table, selling their shares into the strength of the announcement.
It's a stark reminder that in the short term, the stock market isn't a gauge of how good a company is. It's a gauge of how many people want to buy versus how many want to sell at a specific moment.
That's exactly right.
Oddly enough, while the broad tech sector rallied on the NVIDIA news, communication services, the XLC sector, which includes major social media and telecom giants, actually fell 1.3%. What caused that split?
Well, that decline was driven by intense intersector rotation. Large institutional desks were intentionally liquidating their holdings in highly extended mega-cap interactive media and digital advertising platforms.
They were selling their social media stock.
Yep. They needed to free up cash. They cleared that liquidity specifically so they could buy into the small and mid-cap technology pure plays that were directly benefiting from the AI physical infrastructure build-out we just discussed.
Wow, okay. Let's talk about the broader concept of valuation for a second, because this really ties the whole tech story together.
Sure.
The Shiller PE ratio, which is a vital metric for long-term investors, expanded this week to 42.04.
42.04, that's a high number.
Very high. For those who might not follow this specific metric, the Shiller PE, created by Yale professor Robert Shiller, is the cyclically adjusted price-to-earnings ratio.
Right, the CPE ratio.
Instead of just looking at 1 year of corporate earnings, it takes the average of the last 10 years of earnings, adjusted for inflation. It smooths out the chaotic business cycle to give us a true historical look at how expensive the stock market is.
And at 42.04, the market is historically exceptionally expensive.
Yeah.
Under normal monetary conditions, when you have rising short-term treasury yields, like we saw with the 2-year yield hitting an annual peak this week, you would expect widespread multiple compression.
And these stock valuations should come down.
Exactly. Investors generally refuse to pay exorbitant premiums for stocks when they can secure a high risk-free return in government bonds.
Right. I mean, if I look back at history, the only times the Shiller PE is crossed into the 40s were during the peak of the dot-com bubble in the late 90s and the post-pandemic stimulus mania in 2021.
Exactly. 2 very frothy periods.
So if we are sitting at 42.04 right now, are we demanding absolute flawless perfection from these companies? Is there literally zero margin for error left in these tech valuations?
That is precisely the systemic risk. The market is currently operating on the premise of an earnings-driven cushion.
Earnings-driven cushion.
Yeah, investors are consciously willing to tolerate an elevated valuation, multiple and high interest rates exclusively because corporate earnings scorecards continuously clear Wall Street consensus estimates.
As long as the earnings keep beating, they'll keep paying.
Exactly. They view robust nominal growth as the structural justification for paying a massive premium for future cash flows.
But if they miss,
The penalty will be severe. As you noted, there is virtually zero margin for error. Any future deceleration in revenue growth or any sudden reacceleration in operating costs will trigger asymmetric, violent downside penalties for these equities.
the irony of this massive artificial intelligence boom is that hyperscale data centers require unfathomable amounts of physical electricity.
Huge amount.
The digital cloud runs on very physical power. And that reliance brings us crashing back down to reality because physical energy is exactly what the globe was panicking over this week.
Oh, the energy market was wild this week.
Let's transition to the geopolitical whiplash in the commodity markets, because this is the primary engine driving that inflation tax, crushing the consumer.
Right. The energy markets served as the absolute epicenter of global macroeconomic anxiety this week. And the volatility we witnessed was entirely predicated on the ongoing 12-week maritime blockade in the Strait of Hormuz.
To understand the gravity of this, we need to look at the geography.
Let's do it.
The Strait of Hormuz is a narrow choke point between the Persian Gulf and the Gulf of Oman. The blockade there has effectively choked off 14 million barrels of oil from the global market every single day.
14 million barrels.
Every day. Furthermore, it has trapped roughly 20% of the world's daily supply of liquefied natural gas, or LNG. We are talking about the sudden physical removal of 12 to 13% of the daily global crude supply.
And the compounding macroeconomic effects of a supply shock of that magnitude are devastating.
Unprecedented almost.
Earlier in the week, the United Nations held an emergency press conference in New York to address the fallout. They officially downgraded their 2026 global GDP growth forecast to a sluggish 2.5%.
Wow.
Simultaneously, they raised global inflation projections to 3.9%.
The International Monetary Fund, the IMF, also released reports warning that this isn't just an oil problem. They highlighted severe compounding deficits in fertilizers and petrochemicals.
Which is a huge issue.
Natural gas is a primary feedstock for the global fertilizer industry. If you restrict the gas, you restrict the fertilizer, which immediately threatens global agricultural yields and basic food security.
And that data directly circles back to the consumer staples margin compression we discussed earlier.
Oh, right.
The physical constraints in the Middle East are directly raising the cost of grain production, which raises the cost of the cereal box in the American grocery store.
It is a terrifying domino effect. But then right in the middle of the week, we saw an incredible violent whiplash in the pricing.
The rumor mill started churning.
Yes. Rumors started circulating out of Washington regarding a potential diplomatic truce. And the energy market just collapsed.
Just completely fell apart.
The Bloomberg Commodity Energy Subindex, the BCO-NTR, plummeted 6.43%. West Texas Intermediate, or WTI crude, dropped a staggering 11.0% on the week, settling at $96.6 a barrel.
A huge drop.
And the international benchmark, ICE Brent crude, fell 7.64% to $103.54.
What the market witnessed there was the rapid, violent deflation of the war premium.
The war premium.
Yeah. For the preceding month, algorithmic momentum funds and large corporate hedging desks had been artificially elevating the price of raw materials. They were buying aggressive futures contracts, operating under the assumption that the blockade would persist or escalate into a broader regional conflict.
But the moment speculative comments emerged, suggesting that bilateral truce negotiations had entered their final phases.
Those algorithms ruthlessly reversed course. Exactly. Those funds aggressively and systematically liquidated their long oil positions.
It's just jumped it.
Yep.
It was a massive unwinding of speculative capital that had absolutely nothing to do with the physical movement of oil on that specific day and everything to do with repositioning risk parameters.
I really want to dig into a highly specific mechanism here because the spread between the U.S. oil benchmark, WTI, and the international benchmark, Brent, did something absolutely insane this week.
It really did.
According to the data, the crude Brent spread deepened by 101.74%. It widened from a negative $3.44 spread to a negative $6.94 spread. Let's use a functional analogy to explain this transatlantic arbitrage mechanic to the listener.
It is a brilliant example of the internal physical plumbing of the global commodities market. Think of the international oil market like a network of regional grocery stores.
Okay, let's say there is a grocery store in Europe that usually gets its produce from a massive farm in the Middle East.
Okay.
But suddenly, the bridge connecting the Middle East farm to the European store is completely blocked. That's the Strait of Hormuz blockade. Precisely. The European grocer is now in a state of absolute panic. They desperately need produce. So they look across the Atlantic to the United States.
They need a new supplier.
Right. They start aggressively outbidding everyone else to buy light, sweet, crude WTI from American producers in Texas and North Dakota.
And U.S. coastal export docks in the Gulf of Mexico were operating at absolute maximum capacity, trying to load ships to cover this sudden European deficit.
Just pumping as fast as they can.
This intense, panic-driven international demand pushes the price of domestic U.S. oil up very close to the price of international oil. The gap, or the spread between them, becomes very small.
But then the rumors of a diplomatic resolution hit midweek. The European grocer hears a rumor that the bridge to the Middle Eastern farm might reopen tomorrow.
Oh, I see.
Instantly, they halt their expensive, panic-driven orders from the United States. They decide to wait it out.
So suddenly, the American oil producers are still pumping oil at maximum capacity, but the European ships have stopped arriving to pick it up.
Exactly. And because of that sudden evaporation of international demand, the domestic supply of WTI rapidly builds up in local storage facilities in places like Cushing, Oklahoma.
Massive amounts of oil sitting there.
This massive local surplus causes the price of domestic WTI crude to collapse at a much faster velocity than the international Brent benchmark.
The bottom essentially fell out of the U.S. benchmark.
It did.
And this massive widening of the discount window fundamentally altered the financial incentives. It suddenly became much more profitable for U.S. producers to simply lease storage tanks and hoard their physical inventory domestically ahead of the busy summer driving season,
rather than pay exorbitant shipping rates to send it to a European market that was suddenly hesitant to buy.
Wow. What is most critical to understand is that the physical blockade in the Strait of Hormuz wasn't actually lifted.
No, not at all.
By Friday afternoon, physical maritime transit remained heavily restricted due to deep-seated diplomatic disagreements over uranium stockpile limits and naval transit tolls. But the trading algorithms had already done their damage to the pricing structure based purely on the rumor.
It really makes you realize that the commodity market operates like a hypersensitive geopolitical radar.
It does. Every whispered rumor in a Washington hallway causes a massive spike or crash in the financial derivatives of oil. But eventually, the physical reality, the actual cargo ships navigating the strait, has to assert dominance over the algorithmic trading, right?
In the long run, the physical molecule always dictates the price. You cannot power a city with a futures contract. You need the actual coal or natural gas.
Exactly.
But in the short term, liquidity flows and algorithmic positioning can cause these violent, seemingly irrational dislocations.
Interestingly, while the energy sector was crashing on diplomatic hopes, the industrial metals subindex, the BTO-MINKR, actually gained 1.53%. Why did base metals decouple from energy and go up?
Well, that decoupling occurred because industrial metals are reacting to an entirely different set of physical constraints.
Like what?
We are seeing exceptionally low visible warehouse inventories across major global exchanges like the London Metal Exchange. This scarcity is colliding with accelerating factory demand. Copper, aluminum, and nickel caught an aggressive bid this week.
And this ties right back to our NVIDIA story, doesn't it?
Absolutely it does. The massive data center infrastructure expansions required for artificial intelligence, coupled with ongoing clean energy electrical grid upgrades, require millions of tons of physical copper and aluminum.
So it's a structural demand.
Right. That demand is structurally embedded into the global economy and is completely independent of the daily diplomatic noise surrounding crude oil.
So the physical world is frantically demanding the raw materials necessary to build the digital world, and it is largely ignoring the geopolitical theater. Now, all of this physical inflation, the volatile energy cost, the surging metal prices, feeds directly into what is arguably the most complex and terrifying part of the market right now.
The bond market.
Yes, the bond market and the Federal Reserve's next move.
The fixed income squeeze we witnessed this week was historic. The price action was defined by intense, unpredictable volatility and a distinct bear flattening of the U.S. Treasury yield curve.
Let's break down that terminology slowly, because bear flattening is heavy financial jargon.
It is, yeah.
When you look at the data, The spread between the 10-year Treasury yield and the 2-year Treasury yield contracted by a staggering 16.51%.
Massive contraction.
The 2-year yield shot up to an annual peak of 4.127%, while the 10-year yield actually fell slightly to 4.572%. What does this actually mean for the economy?
To understand a bear flattening, you first have to understand the normal shape of a yield curve.
Okay, let's start there.
A yield curve plots the interest rates of government bonds across different maturity dates. Normally, you expect a higher interest rate, or yield, for locking your money up for 10 years compared to just 2 years.
That makes intuitive sense. If I lend the government my money for a decade, I am taking on more inflation risk and opportunity cost than if I only lend it for 2 years.
Exactly.
Therefore, I demand a higher interest rate to compensate for that time. That creates a curve that slopes upward.
Correct. But a bear flattening occurs when the short-term interest rates rise much faster than the long-term interest rates.
Okay.
The term bear in the bond market means bond prices are going down, which mathematically means their yields are going up. So the gap, the spread between the 2-year and the 10-year, shrinks, flattening the curve.
So why did the short end, the 2-year yield, face such aggressive selling pressure this week, pushing its yield to an annual peak?
It was a direct reaction to the release of the Federal Reserve's prior monetary policy meeting minutes.
Ah, the Fed minute.
Yes. Fixed income trading desks aggressively recalibrated their outlooks when they read the transcripts. A majority of central bankers explicitly indicated a willingness to implement further policy tightening, meaning actual interest rate hikes, if inflation remained unanchored.
Wow, rate hikes are back on the table.
Because the 2-year Treasury yield is hypersensitive to the Federal Reserve's immediate policy path, the threat of rate hikes sent the yield spiking.
Meanwhile, the 10-year yield, which represents long-term economic growth expectations, fell slightly late in the week. I assume that was due to the diplomatic trade rumors out of the Middle East cooling off long-term inflation fears.
That is correct. And that massive 16.51% contraction in the spread highlights a growing, terrifying institutional consensus.
Which is?
The market believes nominal economic output is running far too hot in the near term, prompting Fed action, but simultaneously believes that these high long-term borrowing costs will eventually choke out the economy, leading to a restrictive plateau.
This inherent contradiction culminated in a truly bizarre market reaction on Thursday. We received a slate of major economic data. The S&P flash manufacturing PMI, as we noted, hit a 4-year high of 55.3.
Very strong.
Furthermore, weekly initial jobless claims fell to 209,000, indicating a very tight, healthy labor market. Now, if you are a normal person looking at the news, a booming manufacturing sector and low layoffs sounds like a reason to celebrate.
Of course it does.
But the stock market immediately slid on the news. Why did Wall Street hate the fact that the economy is doing well?
It is the defining hallmark of a monetary-driven market. The classic good news is bad news dynamic.
Good news is bad news.
Yeah. When the fundamental economy runs this hot, when factories are expanding and unemployment remains stubbornly low, it sends a very clear signal to the Federal Reserve.
That the economy doesn't need help.
Exactly. It tells the central bank that the economy does not need stimulating. In fact, it urgently needs cooling to prevent inflation from spiraling out of control.
Ah, so strong economic data cements the higher-for-longer interest rate environment.
Exactly. The robust data brought the terrifying prospect of actual near-term rate hikes right back to the forefront of the conversation.
Which equity investors hate.
Yes. Equity investors realized that this strong data meant capital costs were going to remain brutally high, which degrades the future valuations of their stock portfolios. They sold off equities in a defensive reflex against the strength of the economy.
It is a completely twisted logic, but it dictates the daily flow of trillions of dollars.
It does.
But here is the piece of the puzzle that I am struggling to fit. Despite all of this bond market chaos, the severe bear flattening, the panic over Fed rate hikes, the geopolitical supply shocks, we witnessed a massive volatility meltdown in the options market.
The volatility metrics disconnected entirely from the macroeconomic narrative.
Let's look at the numbers. The VIX, which is the primary gauge tracking equity market volatility and fear, dropped 6.29% to close at a deeply complacent 16.70.
Very low.
The MOVI index, which tracked the volatility of the bond market, dropped 8.88%, down to 78.43. And the S&P rate of change, the ROC, stabilized and shot up 604%. How is the surface-level stock market getting calmer, while the underlying mechanical engine of the economy is throwing off sparks?
It comes down to the sudden relaxation of cross-asset capital costs midweek.
Okay, what does that mean?
Well, early in the week, when the bond market was flailing and the two-year yield was spiking, the MV index was trading near its annual highs. High bond volatility acts as a massive structural anchor dragging down equities.
Because things are unpredictable.
Right. Portfolio managers cannot confidently price their models when the risk-free rate is swinging wildly.
But then when the 10-year yield backed down slightly on Wednesday and Thursday due to those Strait of Hormuz diplomatic rumors, the bond market finally stopped panicking.
Exactly. The move-in index compressed for 4 consecutive trading sessions.
And when the bond market stopped panicking, it effectively took the brakes off the equity market.
Yep.
Simultaneously, you had the NVIDIA earnings report validating the structural growth of the entire technology sector. Institutional trading desks realized that the massive artificial intelligence growth story was still completely intact.
So, feeling confident in tech and relieved by the bond market, these massive funds actively decided they no longer needed their insurance policies.
Their downside protection.
Right. They aggressively unwound their downside protective puts, the options contracts that pay out if the market crashes.
That is the mechanical driver of the volatility meltdown.
Yeah.
The systematic draining of the fear premium out of the options chains caused the VIX to plummet.
And in modern structure of the stock market, dropping volatility forces systematic, automated trading funds to structurally increase their risk exposure.
Wait, so essentially, algorithmic trading desks were forced by their own programming to buy index futures simply because the fear gauge broke.
Yes.
That sounds less like a healthy fundamental rally and much more like a technical mirage, masking real economic danger.
It is absolutely a highly technical stabilization. The volatility meltdown provides immediate tactical support for stock prices, pushing indices to new highs, regardless of the underlying macroeconomic deterioration in the consumer or the energy supply chain.
Which is terrifying.
It is. It leaves the market incredibly vulnerable. Because institutional hedging is now sitting at pre-crisis levels of complacency, there is very little safety net beneath the market.
So if bad news hits, there's nothing to catch the fall.
Exactly. It is highly susceptible to an asymmetric shock if incoming data suddenly turns hostile.
Which brings us perfectly to the look ahead. With this incredibly fragile, low volatility equilibrium temporarily established, what exactly do investors need to brace for next week?
We have a lot coming up.
We are looking at the economic and corporate calendar for the week of May 25th to May 29th, 2026. What is on the docket that could potentially shatter this complacency?
Well, the upcoming economic calendar is exceptionally heavy, and it is perfectly designed to test the exact stress points we've analyzed today.
Excellent. Where do we start?
On Tuesday, May 26th, we received the Conference Board's Consumer Conference Report.
Oh, that's going to be closely watched. Following the catastrophic 44.8 reading from the University of Michigan, portfolio managers are going to be scrutinizing this Tuesday report meticulously.
They absolutely will.
They need to see if the severe drop in confidence is uniform across all socioeconomic tiers, or if the upper-class discretionary spender is finally starting to crack under the pressure.
But the truly defining moment of the week will arrive on Thursday, May 28th.
What happens Thursday?
We will receive the Core PCE Price Index, released alongside initial jobless claims and new home sales data.
The Core PCE, the Personal Consumption Expenditure Price Index. Let's explain why this specific report matters more than the Standard Consumer Price Index, or CPI, that most people see on the news.
The Core PCE measures the changes in the prices of goods and services actively purchased by consumers, but it intentionally excludes the highly volatile food and energy sector.
So it strips out the oil and grocery noise.
Right. By stripping out that noise, it reveals the sticky underlying structural inflation embedded within the economy. Most importantly, it is the Federal Reserve's absolutely preferred inflation gauge when determining whether to hike or cut interest rates.
So if you are an investor, this is the moment of truth. If the Core PCE data comes in unexpectedly hot on Thursday morning,
If the PCE prints hot, that fragile, low volatility consolidation in the options market will shatter instantly.
ooh,
Yeah. The prevailing market thesis that inflation is manageable will be broken. The fear of imminent Fed rate hikes will go into absolute overdrive, causing the two-year Treasury yield to spike violently.
and what happens to stocks?
It would be highly negative for all risk assets, particularly those highly valued technology stocks.
We wrap up the macroeconomic data week on Friday, May 29th. with the Chicago PMI, which will give us a localized pulse on manufacturing health in the Midwest.
Right.
But alongside the macro data, we also have some massive corporate earnings reports next week that will act as the ultimate real-world barometers.
We do.
Wednesday brings quarterly scorecards from Salesforce, Agilent, and Dick's Sporting Goods. Thursday delivers reports from Costco, Marvell Technology, and Dell.
Those specific corporate earnings will perfectly test the two primary themes of our macro divergence.
How so? Let's start with Costco.
Costco will serve as the definitive real-time test of the American consumer. It will demonstrate the resilience of upper-middle-class discretionary spending patterns and bulk buying behaviors.
And if they show weakness.
If Costco's forward guidance shows unexpected weakness or slowing membership revenue, it confirms that the heavy inflation tax has finally breached the higher income brackets.
That would be a major red flag. And the technology reports from Salesforce and Dell.
They are the vital secondary tests for the artificial intelligence momentum that NVIDIA catalyzed this week.
Because NVIDIA sells the chips, but these guys use them.
Exactly. Salesforce will prove whether NVIDIA's massive hardware boom is actually successfully trickling down into tangible enterprise software applications and recurring revenue models.
Dell.
Meanwhile, Dell will demonstrate if the physical hardware server demand required to build out that data center infrastructure is accelerating fast enough to sustain their elevated valuation multiples.
So as an investor staring down the barrel of this upcoming week's data, how do you logically position yourself for Thursday's pivotal PCE print?
That is the big question.
Do you retreat, hide your capital in cash and short-term treasuries, or do you ride the momentum of the low volatility wave and stay fully invested?
That is the multi-trillion-dollar strategic question facing every portfolio manager right now. The technical setup of the market suggests that the path of least resistance is currently higher.
Upward momentum.
Right. The upward momentum is characterized by an incremental mechanical drift toward fresh nominal peaks, largely supported by that rotation into mid-caps and cyclicals. It looks technically healthy on the surface.
However, that severe complacency in the options market, that massive drop in the VIX, means you are operating without a net.
Precisely. Because institutional hedging is so historically low, you have very little safety margin.
So what's the play?
If you are an investor positioned heavily in long-duration, high-growth technology assets, you must actively ensure you have adequate downside portfolio protection in place.
Buy some insurance.
Yes. If that Thursday PCE print surprises to the upside, the subsequent repricing of interest rates will be swift and unforgiving.
Let's bring this all together. What an absolutely staggering week of financial crosscurrents. We watched Wall Street exhibit an incredible, almost defiant resilience.
Defiant is the right word.
The major equity indices successfully navigated an absolute gauntlet of systemic threats. Hawkish Federal Reserve minutes threatening immediate rate hikes, a severe bear flattening yield curve indicating deep structural economic friction, and intense Middle East geopolitical standoffs choking off the global physical energy supply.
Despite all of those severe headwinds, the market was secured by a massive structural rotation of capital into small and mid-cap domestic value plays.
The Russell Index magic.
Right. Combined with an absolutely flawless historic artificial intelligence earnings report from NVIDIA, it was a masterclass in market decoupling. Capital seamlessly rotated out of vulnerable defensive consumer staples and bloated mega caps, finding strategic refuge in agile cyclicals and the foundational architecture of technological infrastructure.
But as we look forward to the rest of 2026, the structural integrity of this entire rally remains entirely dependent on the bond market remaining stable and the assumption that the consumer won't completely collapse.
The consumer is the wild card.
And that brings us right back to where we started this deep dive, the overarching defining paradox of our time.
The Shiller PE versus sentiment.
Yes, the Shiller PE ratio is currently expanding to multi-year highs, sitting well above 42, which signals extreme, almost euphoric optimism regarding the future of corporate profitability.
Everything is awesome.
But meanwhile, the University of Michigan Consumer Sentiment Index sits at an all-time historical low of 44.8, signaling unprecedented visceral despair among the very people expected to buy those corporate products.
It is the ultimate macroeconomic divergence. One data set is pricing in a utopian technological future, while the other is pricing in a crushing stagflationary reality.
And history tells us, time and time again, that these two fundamental metrics cannot diverge forever. Eventually, the reality of the corporation and the reality of the household consumer must align.
They always do.
So as we wrap up this analysis, I want to leave you with a lingering question to mull over as you review your portfolios this weekend. Which one is going to snap first?
It's the multi-trillion-dollar question.
Will corporate earnings finally fall under the crushing weight of margin compression to meet the struggling, tapped-out consumer? Or will the consumer, battered by relentless energy inflation, somehow find the financial footing to rise up and meet Wall Street's lofty, perfectly priced expectations?
That is the definitive question that will dictate the flow of capital, not just next week, but for the remainder of the decade.
If you enjoy Wall Street Weekly's market analysis, subscribe and leave a comment wherever you listen to your podcasts, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.